The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. Investing involves risk, including loss of principal. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial advisor or tax advisor prior to investing. Securities are offered through LPL Financial, member FINRA SIPC. People of Chicago, you're tuned into In the Know Radio, a show about money, investing, retirement, and life with your hosts, Craig and Leslie Bolanos, co-founders of Wealth Management Group.
It's time, America. Get your game face on.
Put your savings to work and finance the lifestyle you want with real advice from real people.
You're emotionally tied to your money.
Separate the confusion from the facts to get prepared for whatever comes your way and get it right here.
You got to make sure you've got plans for a rainy day.
What's the number you need to live out your retirement dreams?
$60 billion.
Holy cow!
Wait, did Leslie really just say $60 billion? All you need to know is that Wealth Management Group is in the financial planning business, so you can be in the fun and retirement business. So get your retirement on, people. Their phone lines are always open at 833-WMG-PLAN. Now, here's Craig and Leslie.
Hey, good morning and a very happy Sunday to you. And I've got to say, we're talking about sincere and actionable ideas that you can use to improve the lives of yourself and your loved ones financially. Because it's not enough to get retired. You got to stay retired. And you know what? No one wants to go into retirement just surviving. You want to go into retirement and do your own version of thriving. And that's going to take a plan. It's going to take money. It's going to take discipline. It's going to take strategies that are TNT, tested in the trenches. And that's what we do, and we do it well. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Connect with us online. Get Retired, Stay Retired.com. Get Retired, Stay Retired.com. So when I think about the markets, the economic data recently, it's been almost Goldilocks. Really, Goldilocks. It hasn't been too hot. It hasn't been too cold. It's all felt just about right. And to make sure you understand Goldilocks from a trading perspective, Goldilocks from an investment perspective, it's as simple as, the data we got a week and a half ago, the ISM data, the PMI data, the jobs report data, and all that data did is it kept the soft landing intact, meaning the Federal Reserve, especially on the back of inflation expectations coming in year over year, where people thought they would be, 2.7, it means the Fed is likely going to give us that rate cut again in December. That'll be the third rate cut, September, November, again in December. And the market appears to be pricing in 2 to 3 additional cuts in 2025. And that's good for borrowers. That's good for homeowners. That's good for everybody. And in addition to that, there are so many people that seem to be worried about a future state. I like to talk about the current state. We're talking about where the economy and the market is so you can make good decisions with us on your 401k, your investments. I mean, the news has been solidly positive. I mean, especially when you consider the fact that we're in this good seasonal period. It's a seasonal period, not just of holiday bliss, but a seasonal period of consumerism. Look at the record spending that happened on Black Friday. The record spending that happened on Cyber Monday. And before anybody says, oh, that record spending occurred simply because everything cost so much more than it did. No, adjusted for inflation, the spending was still up year over year. So to that point, when you start looking forward about where we're at into 2025, you got to pay attention to things, whether it's tariffs, other things on trade. But I think the current situation really is this again. Let's just level set and break it down. Economic growth right now, it looks like Goldilocks. It's further reinforced a soft landing. Yields on treasury bonds, which did go higher after the election, which isn't good, we're back down to pre-election, if not lower levels on treasuries. You got solid fundamental economic growth. We have an ongoing rate cutting cycle. You've got treasury yields, as I just mentioned, that are back below their pre-election levels. You've got no actual tariff disruption, just lots of big talk. And you know what that means? The year-end rally likely stays intact, and investors might just want to brace that 2025 gains could be pulled forward into the early part of next year. But this is radio. We want to make sure we're being fair and balanced. So what else is it that we're looking at? Again, if you're just joining, we're talking about the market, the current economic conditions, what you need to be thinking about when you're going into your year-end rebalancing. And what we are thinking about at our firm right now is I'm saying the only way things get worse is if all of a sudden the economic data that's been nice deteriorates and recession concerns come out of nowhere. Or maybe the yields on treasury bonds spike higher because people get worried we'll do too much stimulus, spend too much money, cut taxes too much. Maybe, just maybe, we get into a trade war. But those are all things that are possible to happen. They're not things that are probable to happen. And when was the last time you made really important decisions with your finances based on what was possible? I think when you make decisions with your finances based on everything that's probable, it leads to a better outcome more often than not, because when decisions are measured, that means they're data dependent, they're devoid of emotion. It's a good thing. So what do you do with that information? I think there's some obvious stuff. Number one, there's nothing wrong, and everyone should be encouraged. Warren Buffett says the only free lunch when it comes to investing is diversification. So yes, people should build a global, diversified, multi-asset class portfolio. But is anyone really interested in overweighting emerging markets right now? Is anybody really interested in overweighting Europe right now? No, it doesn't matter that those markets are on sale. It doesn't matter that the price to earnings ratios are low. You know what? It's an incredibly intriguing story, but the trend is your friend. New highs tend to make new highs. And the North American story, the US story, is alive and strong. So we think investors should be diversified, but the US probably should be your largest holding. Part number two, if you do believe in deregulation, if you do believe in better, improved economic conditions, if you do believe that we're going to eliminate a lot of red tape, if we're going to allow banks to loan out even more money, then you've got to say to yourself, wait, interest rates are going to come down again in December. 2 to 3 rate cuts in 2025. What does that benefit? It's going to benefit the S&P 600 small caps, the S&P 400 mid caps, and both of those indices have consistently underperformed their large brother, the S&P 500 large caps. So wouldn't now be a great time as you go into the end of the year to start rebalancing your portfolio to make sure you own enough mid caps and own enough small caps in case that's where the rebound and the growth comes from. And in addition, everybody knows the stocks that have been on fire. Everybody knows who the Magnificent Seven are. People know who the FANG stocks are. You know who the Elite Eight are. They're all different permutations of similar company names. But if you believe in a story that is a soft landing, you believe in a story that's possible, which is no landing. We just have an economy that does in-flight refueling, doesn't even slow down, actually begins to accelerate and take off, then you're going to want to own industrial names. You're definitely going to want to own names in the energy services space. You're going to want to be owning names in consumer discretionary as things get better. You don't want to simply have tech be your only holding. That's something else to think about going into the end of the year. You know what? Speaking of going into the end of the year, we're about to finish up 2024. That means your last opportunity to do some things that are tax smart. Because again, what's your single biggest investment? I know mine, single biggest expense rather, my biggest expense is income taxes. I bet you yours is too. So we probably ought to talk about some tax saving strategies that we can use. And we'll do that after this break. But in the interim, here's what I want you to do. If you find yourself listening in the car today, you find yourself listening in the kitchen, you find yourself listening in whatever capacity you do, because you like this radio station. You like the personalities that are on this radio station. You enjoy the messaging that comes from AM 560, The Answer, because you want to be informed and you believe education is empowering. Well, we want to help you in that endeavor. We want to help you bring it all together. We want you to have the chance to experience the difference when all under one roof, you can interact with your tax strategist, your estate strategist, your retiree healthcare strategist, your registered investment advisor, your financial planner, your insurance agent. When you bring all of those services together under one roof, that's what a family office is. It's the ability for you to engage in multiple disciplines in a coordinated state of care to get a better outcome, one that's rooted in proactive strategies as opposed to one that's reactive. And if you want to learn more, you can. I think you should. Give us a call today, 833-964-PLAN. 833-964-PLAN. Check us out on the website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. When we come back, we're going to talk about some year-end tax saving strategies that you should be using now. Craig Bolanos, AM 560, The Answer.
The No Radio with Craig and Leslie Bolanos, where their goal is to pummel you with financial know-how until you say uncle.
We're going to talk about some year-end tax strategies, so let's get there now. Part number one. If you haven't funded a deductible IRA and your income qualifies, now is the time to get that done. Sure, you can wait until tax filing time, but if you know you qualify for a tax-deductible IRA, let's get this thing funded now while market conditions remain good. Part number two, do you have a health savings account? Do you have a high deductible healthcare plan that's HSA eligible? If so, let's make sure that we put away pre-tax dollars, tax deductible dollars into that HSA to lower your adjusted gross income, hence to lower your tax bill or get you a larger refund. Number three, if you have any investments that are in a taxable account that have gone down in value, now is a great time to do tax loss harvesting or swaps. Someone called me last week and they said, hey, I bought on my own some of these marijuana stocks, some of these marijuana Canadian royalty trusts, they're down in value. I said, hey, those things happen. Take a tax loss and immediately reinvest into a similar but not identical marijuana ETF or Canadian royalty trust to keep the exposure, but make sure you get the valuable tax deduction that your 1040 deserves. What else is on my list? Start getting prepared for next year. And what I mean by getting prepared for next year, for 2025, is if you're a business owner, that corporate tax return is due March 15th. And if you don't want to have an ugly surprise on that March 15th tax return, let's take a look at what year-end business expenses we can run through. In addition, if you have a pass-through business in the state of Illinois, no one likes the Illinois replacement tax of 1.5%. No one likes their cap of state and local taxes at 10 grand. So are you doing a PTIT, a pass-through entity tax? Are you doing the PTIT workaround so you can pay your state of Illinois taxes through your pass-through business, hence have them deducted versus having those taxes capped out on Schedule A of your return? I think that's so critical and so incredibly important for absolutely anybody. So I want to make sure that you're doing those basic things. And there's so much more that you can do. There's a lot you probably should do. And I encourage you to pick up the phone and give us a call. 833-964-PLAN. That's 833-964-PLAN. Go to our website, getretiredstayretired.com. A lot of the leverage, it comes from tax planning. Speaking of tax planning, maybe you sold a business this year. Maybe you took on a private equity partner for a part of that business. Maybe you just had a high income. Have you thought about making some charitable contributions at the end of the year? But maybe you're not sure how much you want to give away. Maybe you're not sure what charities you want to support. Well, enter in the Donor Advised Fund. That Donor Advised Fund allows you to go ahead and contribute today. Take a full tax deduction for your contribution today, but you have no requirement to grant the money from your Donor Advised Fund to charity until a time that you see fit. In fact, let me use an example. We have a client who had a really high income year. That client held some of these technology stocks. The client also wanted to do a Roth conversion because they want to get money to the tax-free safety zone. And we worked with the client and we said, you know what? You're charitably inclined. Why don't we make a contribution to your Donor Advised Fund today? And they got excited. They're like, that's great. I'm going to get a full tax deduction today, but then I don't need to start making distributions from my Donor Advised Fund until future years at different times and installments that are right for me. It's not that simple, but it can be. And we make the complex feel simplex. Give us a call, 833-964-PLAN, getretiredstayretired.com. That's getretiredstayretired.com. Hey, did you know people were popping champagne this week? Oh, yeah, they were. There's a certain index, I call it the NASDAQ, and it went over 20,000. Might not have stayed there, but it went over 20,000. Boy, I still remember when the Dow Jones first went over 10,000. But the NASDAQ just eclipsed 20,000, due in large part to things like generative AI, the story that was 2023 and 2024, generative AI. And discussions of AI also, I think, sometimes lead to discussions of cryptocurrency. And why shouldn't it? Because with a new administration comes a new year, and many investors are wondering what the future holds for virtual currency, digital currency, cryptocurrency. But there's a positive outlook that's here. And there's a positive outlook because there's going to be appointments made. They've already been appointed. We just have to have them confirmed. But there's appointments being made into our government for those that are more friendly to virtual currency. In addition to that, the most popular virtual currency, Bitcoin, is supported by a lot of exchange-traded funds, ETFs. So access is all of a sudden easier than ever, within reach for so many people if they want to participate. So today is not a discussion of whether or not you should be involved in cryptocurrency, but today is a reminder that if you're looking for storages of value, alternative storages of value, that gets you into the discussion of precious metals, gets you into the discussion of real estate, gets you into the discussion of cryptocurrency. And if you want to learn more, you can. You want to learn more, you should. Give us a call, 833-964-PLAN. That's 833-964-PLAN. Or go out to our website, getretiredstayretired.com. Again, that's getretiredstayretired.com. And let's not lose sight of something. If you have been involved in cryptocurrencies for a long time, best you start getting your cost basis, all of those things in line, because starting in 2025, you know what's going to happen. All of those online hosted wallets, everyone else who's helping you do cryptocurrency, they're going to be responsible for reporting those gains and losses on a 1099. So if you're going to be reporting transactions on your 1040, you darn well got to make sure you've got the documentation to support the gain or loss that you're going to be claiming. Now, Speaking of things, we got to talk a little bit about something. I just talked about alternative storages of value, and I think that's a great segue into this. We talked in our first segment about the only free lunch when it comes to investing is diversification. And a lot of people do a very good job of diversifying across public securities, stocks, bonds, etc. But there's an entire world of securities that aren't public. They're private. And that gets you into the world of private equity, private lending, all these different spots. And if you've ever said to yourself, part of getting retired and staying retired is having a plan. Part of getting retired and staying retired is focusing on storages of value. I would argue now is a great time, not because anything's going wrong in the economy, not because anything's going wrong in publicly traded stock or bond markets, but now is a great time to be rebalancing, not just into lower market capitalizations, like I mentioned, small and mid caps in my first segment. Now is a great time to maybe start taking portions of your gains that you've enjoyed the last 1 to 2 years and deploying those gains into alternative investments as storages of value. And that means getting involved in things like industrial warehousing. That means getting involved in things like infrastructure real estate. I think that can also mean getting involved in lending as an alternative form of bonds, meaning participating in the world of private credit. And if you want to learn more about what it takes to be a qualified purchaser, what it takes to be a qualified client, what it takes to be an accredited investor, what it takes to have access to those programs, well, we're a gateway and a conduit to just that. So if you've ever wondered how to start building with measured intentions, alternative investments the right way into your portfolio, give us a call. 833-964-PLAN. That's 833-964-PLAN. Or check us out on the website, getretiredstayretired.com. That's getretiredstayretired.com. And we'll discuss with you what it means to be an investor of different qualifications, what that then gives you access to in the world of private equity, business development companies, interval funds, how different structures of real estate, lending, areas of finance can contribute potentially over time alpha to your portfolio, and how to make sure we use asset location to create better after-tax return parameters. And if that's of interest, I want to talk to you myself. So 833-964-PLAN, go to the website, getretiredstayretired.com. More to come right after this.
More In the Know Radio? You want more In the Know Radio? You can't handle more In the Know Radio. Yeah, you can. Welcome back. Here's more with Craig and Leslie.
There's no doubt that for those of you that might have adult children, myself and Leslie, we have adult kids. We got 2 boys. One of them's getting married, launching into life. The other one's about to graduate college, launch into life. And you know what? Things are more expensive. Housing is more out of reach than it used to be. Doesn't mean they're not going to be successful. But if you're compelled to help, there's a difference between enabling and helping. And I think sometimes it's a fine line. But if you've ever wanted to participate in the lives of your adult children or grandchildren, let's talk about some ways you can do that. The first thing I think about time and time again is if you believe that education leads to empowerment, that education is pivotal, then consider being the educational czar for your extended family. Yes, name yourself the self-appointed education czar. And what you do is then you look at those grandchildren and you consider creating 529 savings plans. And when you have a 529 savings plan, it's an asset that you own. that you control, that you name the beneficiary. So think about that. You own it, you control it, those are keys, and you simply name a beneficiary. And with that 529 savings plan, if you're a resident in Illinois, you can actually get a tax deduction worth up to $20,000 if you file jointly on your Illinois tax return. Boy, that's valuable. And a 529 plan gives you tax deferred earnings. If you use the money in a 529 plan for qualified education expenses, K through 12 private school, trade school that's accredited, community college, undergraduate, graduate work, public, private, anywhere in the United States or even Puerto Rico, then those qualifying withdrawals all come out tax-free. That means as an Illinois resident using an Illinois 529 plan, you got contributions that were tax deductible, enjoyed tax-free growth, and gave you, tax-free distributions. Oh my gosh, it's glorious. So really think critically that if you've got enough money and you want to start gifting, but you're not ready to give up control yet, let's think about adopting a 529 collegiate savings plan strategy that you'll own, that you'll control, that has plenty of off-ramps. Because what if the kids or the grandkids do get scholarships? What if the kids and grandkids don't go to college? I mean, now that you can repatriate monies from 529 plans into Roth IRAs, these are really just no-brainer decisions. What's another way you can maybe start helping? We're talking about the next generation. If we want to do some intelligent gifting, because gifting comes in many forms. For a lot of us, we start with random acts of kindness for our adult kids or our grandkids. Random acts of kindness could be picking up the dinner bill. Random acts of kindness could be helping with this or that. Random acts of kindness are things we use or we do that we don't keep score on. We just do them because we want to do them. But when it comes to gifting, that's something that people keep score with, like setting up a 529 plan or giving up to $18,000 per year to someone that we love without the need to file a gift tax return. And maybe a great way to empower those people in your lives is to encourage them to fund a Roth IRA. And if they've had earned income, maybe instead of writing them a check, maybe you give them the money to put in a Roth IRA to teach them the principles of building for retirement, the principles of creating tax-free wealth with a Roth. I think that's a great idea. Maybe you are ready to start gifting to each of your kids. But you worry that if you gift to your kids each and every year using that $18,000 annual gift exclusion, you're worried that your gifts might become marital property because you're worried that your kid lives in a community property state. You're worried your kid might get divorced in the future. Well, if that's the case, it shouldn't stop you from gifting. It just means we need to gift with documentation. So let's consider setting up a very simple, basic trust account for your adult children or grandchildren that we can gift into each year while having some governance in how the money can be accessed, governance in when the money can be accessed, governance in making sure it doesn't become marital property. There's a lot of things we can do that's exciting. What if you want to do gifting on steroids? That means you want to give more than that $18,000 annual exclusion. Well, there's a certain set of laws on the books called the Tax Cut and Jobs Act that if you said something wild, like I want to give my son or daughter $100,000 today, but I'm worried I can't because $100,000 is more than the $18,000 limit, I got good news. You can write a check for $100,000 today. It'll go off of your lifetime gift exemption, but you won't pay any taxes on it. The child who receives it won't pay any taxes on it, even though it's above the annual exclusion amount. We just need to document it. So where am I going with this? There are so many strategies you can use. But if you've already been doing random acts of kindness for your kids and grandkids, and you're ready to start doing some gifting on a routine basis, I call gifting with structure. Well, let's make sure you get educated on all the possibilities that you could use. The legal framework, the titling of accounts, best practices for money to be spent or best practices for money to be invested for the future. And I think once you're armed with all that information on a whiteboard, there's going to be a pathway forward for you that just resonates, because all of us see the world through our own set of lenses. And I'm convinced that if you know about all the tools and techniques you can use, and we can get them onto a whiteboard, then you're going to naturally gravitate something that resonates based on your experience, your unique family, and then we can help you implement. 833-964-PLAN. That's 833-964-PLAN. The website, getretiredstayretired.com. That's getretiredstayretired.com. So we were talking about the kids' gifting of monies, and I think that leads into one other topic: not leaving your heirs a tax time bomb. We've been talking about that for more than a decade on this radio station alone. But all of us, whoever are of a certain age, we played by the rules. We saved and invest, grow and protected, built up these nest eggs in our 401ks, 403bs, 457s, IRAs, not realizing that we could be creating a tax time bomb. And we celebrated the fact that those who are going to receive those monies from us one day, our spouse, our adult children, would have some flexibility. But now the Secure Act came and wiped the majority of that away. And now all these taxes hit like a ton of bricks when people inherit our retirement accounts. And I always think about being empowered. Empowered means we choose where our money goes and how it's spent, versus the taxing authorities redistributing and spending our money how they see fit. And if my concept resonates with you because you want to be in control of your money versus letting the taxing authorities decide how it's going to be done for you, I think you got to come visit. GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. Our number, 833-964-PLAN. 833-964-PLAN. Think about what we talked about today. Income taxes, investing, gifting, various strategies. That's what we do. A family office is designed to give you strategies that are TNT, tests in the trenches. We'll talk more about strategies after this important commercial break.
Omelets? Good, because Craig and Leslie are back, and they're about to crack some eggs of retirement knowledge all over Chicago. Back to In the Know Radio.
I was watching President-elect Donald Trump ring the bell on the floor of the NYSE. It was a big deal on Thursday of this week. That pro-business, pro-growth, pro-America policy was just resonating in his prepared talking remarks to everybody who was on the floor of the New York Stock Exchange. And a lot of this growth and different stuff is regarding policies. And one of the things he said is trying to lower the corporate tax rate further, but only lowering it for those companies who are onshoring. Onshoring means bringing those jobs back from overseas and doing it right here. That's the manufacturing, the component assembly in the United States. That was a twist from how he positioned tax cuts previously. It was smart. It resonated with people as now being possible, could potentially be probable. But what about everyday America? What about all of us? What do we see? Not corporations. I think if there's one thing that's a sure thing, is in DC, there's likely to be an extension of the Tax Cuts and Jobs Act. And you have to remember that the Tax Cut and Jobs Act was the single largest sweeping overhaul of the tax code that we've seen in more than 4 decades when it came through under President Trump's first administration. It cut marginal rates, doubled the standard deduction, and significantly limited itemized deductions in favor of those other two. But I think this thing is going to get renewed. And I think that'll be good for most Americans. Something else that's equally important, if you're a family that has already created wealth, you're a family that has a goal and an eye on preserving multi-generational wealth, well, then you have to celebrate the fact that the estate exemptions remain high. I mean, because I remember a time, and it wasn't that long ago. Sure, I know what you're thinking. Craig, the 1990s was a long time ago. Feels like yesterday to me. But I remember when men and women in this country, if they were married, paid estate taxes if their net worth was more than 1.2 million. But with the growth in real estate, the growth in investment portfolios, that'd be terrible in today's world. So we saw those estate exemptions grow and grow and grow, not grow quick enough, in my opinion, over time. And the Tax Cut and Jobs Act tremendously expanded those estate tax exemptions so that now a married couple isn't paying death and transfer taxes unless they've achieved more than $27 million. And you know what? Those exemptions were all going to expire. They were all going to go away, but they're going to be renewed. And that gives wealthy families time to be measured, intentional, thoughtful in their plans, because when the Tax Cut and Jobs Act is renewed, it's going to be renewed. It's probably going to expire again in the future. And if you don't want to worry about the future state of who's in control of policy, you'll want to use the favorable laws while we're on the books to protect you and your loved ones. Number 3, this would be a twist. I remember seeing lines of people near their city halls, per se, back in 2017, hoping to pay in advance some of their state and local taxes while it was still going to be deductible above the 10,000 mark. Oh yeah, that's been a big deal, especially for people in Illinois, especially for people in Cook and DuPage County. Property taxes are high. They remain high. And the fact that you can only take a deduction on your state, you can only take a deduction on Schedule A, which is where you itemize your deductions of $10,000 for state and local taxes. It would be miraculous if we could see a workaround or a change on the SALT cap for everybody, not just the business owners I mentioned in our second radio segment today, where you already have a workaround using pass-through entity tax laws. If you missed that and you want to learn more, give me a call. 833-964-PLAN. And a lot of people say, is there going to be a change in Social Security? Is there going to be a change in Social Security taxation? I don't think there's going to be one under the current administration. I don't. I think you see some changes to the corporate tax code. I think you see a full extension of the Tax Cut and Jobs Act. I think you potentially see a SALT cap workaround. All of those things are stimulative. All of those things are accretive. All of those things continue to add to the narrative I said of this soft landing, not too hot, not too cold. So pay attention, think about what it means to you, and get advice, discipline, and strategy so that you and your family can persevere moving forward. Now, speaking of things, it is the end of the year. I talked about rebalancing your global footprint. I talked about rebalancing your portfolio for your market cap footprint, large, mid, and small. I talked about rebalancing your sectors to don't forsake industrials, energy, consumer discretionary. But what about your fixed income? What about your bonds? With Treasury yields having come back to pre-election levels? with rate cuts coming in December, with 2 to 3 rate cuts priced in for 2025, I think investors should really be focused on where their money is deposited. I think investors, when you think about a bond portfolio, you might compare that bond portfolio to, say, a proxy like the aggregate bond index. And I think it still makes a ton of sense for all you bond investors are out there. And if you have a diversified portfolio, I wouldn't be surprised that you have 10, 15, 20, 30, 40% of your money in bonds. So let's talk about it. I think it makes sense that you keep a high credit quality, A or A minus in your overall bonds, because bonds are about preserving wealth and generating income. I think the average duration, the average maturity of your bonds, meaning your bond sensitivity to a given change in interest rates caused by changes in inflation. I think keeping your fixed income or your bond portfolio's duration around 5, which is lower than the proxy, the aggregate bond index is 6. I think that makes sense because there is some concern that the inflation has arrested, meaning the inflation has stopped falling. But 2.7% year over year is a hell of a lot better than what we used to be dealing with. The other thing I think you should be thinking about is the sectors of the bond market that you're invested in. And we divide bonds into 16 different flavors, not just taxable bonds versus tax-free bonds. But you need to look at asset-backed bonds, all the different flavors. And your bond portfolio deserves to get the care and attention that the stock side of your portfolio often gets. And if you worry that the bonds in your portfolio aren't being shown the love that you deserve, that could be an educational gap on your side. It could be an educational gap on your advisor's side. It could be a whole host of things that are causing the imbalance and the lack of participation that you deserve in your bond portfolio. Just know that all teams have different sets of resources. We have custody and clearing relationships with multiple custodians. Our director of trading operations used to be on the floor of the New York Stock Exchange. We don't just have knowledge, which is IQ, intelligent quotient. We have another form of IQ, which is implementation quotient that other advisors might not have access to. And if you want to learn more, you can, you should. Give us a call, 833-964-PLAN, 833-964-PLAN. Go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. We're going to take a break, pay some bills, do a commercial. We'll be right back. More to come. In the Know, Craig Bolanos, AM 560, The Answer.
Get ready to be blown away with a hefty gust of more financial know-how, because we're back with In the Know Radio with Craig Bolanos.
Maybe 2025 is going to be your year. Not the year the Bears win the Super Bowl. Not the year the Blackhawks finally get on top. Not the year that the White Sox finally get it right. Maybe 2025 is going to be the year that you can finally retire. It's the year you've hit critical mass. It's the year you've put it all together. Well, what are you going to do? I think it's time you start test driving retirement before you actually pull the trigger. I mean, we need to do a full retirement plan, a retirement plan that's not just goals-based. Goals-based meaning the basic dollars and cents, how much you plan to spend, what type of resources you have today, what type of liabilities you have today. You also need to do cash flow planning. Where is the money going to come from? From which accounts? How are those accounts taxed? How should those accounts be invested? You need to have a plan for how you're going to satisfy your tax obligations. If you're no longer going to have your withholding from the W-2, your paycheck, how are you going to get your taxes paid? You need to start test driving the budget. It's not a discussion of needs versus wants. It's a discussion of being real. How much do you think you're really going to spend in retirement? Which means we need to know not what you're doing today. We need to know what it is you're retiring to. Seriously, what's the lifestyle you're retiring to? Where are you going to live? What passions are you going to reconnect with? What's going to get you up out of bed every day with passion and meaningful purpose? You're no longer working. How are we going to solve for the retiree healthcare conundrum if we're pre-65? How are we going to tackle things like long-term care? What if you're married and one spouse gets sick for an extended period of time? How do we make sure the healthy spouse isn't financially impoverished? These are just a sample of some of the things we got to do. And the benefit of working with a family office like ours is we have access to a team of talented professionals, each with their own specialty, their own discipline per se, in cash flow modeling, goals-based planning, investing under a fiduciary standard, doing the retirement sims under the CFP standard of care, handling the taxes, handling the estate, handling the retiree health care. And if all of that sounds of interest and you want to learn more, 833-964-PLAN, 833-964-PLAN, getretired, stayretired.com.